Hello everyone, welcome to my channel. In this video we will be discussing the 2008 stock market crash in India and also about its impact on the economy and on investors as well. We will also discuss about the steps taken by government to stabilize the economy. So let's start. The Indian stock market had been on a bull run for several years leading up to 2008. With the Bombay Stock Exchange Sensex index reaching an all-time high of 21,206.77 points in January 2008. However, in the second half of the year, the market began to decline sharply. The 2008 stock market crash in India was primarily caused by the global financial crisis that originated in the United States. The crisis began with the subprime mortgage bubble in the US, which eventually led to the collapse of several large financial institutions, causing a ripple effect that spread to the global financial system. The crash had a significant impact on the Indian economy and thousands of investors lost their lifelong savings, and there were widespread protests calling for government to stabilize the market. The market crash also highlighted the importance of diversification and risk management in a portfolio. Investors learned to be cautious and to keep an eye on global economic and market trends. Those who did, were able to weather the storm and come out stronger. Let's now take a deeper dive into the effects of the 2008 stock market crash in India. Number 1. Impact on the Indian economy. The 2008 stock market crash had a significant impact on the Indian economy. The crash led to a decline in economic growth, and many businesses had to shut down due to a lack of capital. The real estate market also suffered, as demand for property decreased. The crash also had an impact on the Indian banking system. Many banks had invested in the stock market and suffered huge losses. This led to a decrease in the availability of credit, which affected businesses and consumers alike. Number 2. Effects on investors. The 2008 stock market crash had a severe impact on investors in India. Many investors lost a significant portion of their savings, and some lost everything. The crash highlighted the importance of diversification and risk management in a portfolio, as many investors had concentrated their investments in the stock market. The crash also led to a decrease in investor confidence. Many investors became hesitant to invest in the stock market, and some even withdrew their funds from the market. Number 3. Government intervention. The Indian government and central bank took several measures to stabilize the market after the crash. The Reserve Bank of India reduced interest rates and injected liquidity into the system. The government also eased restrictions on foreign investment, hoping to attract more capital into the Indian market. The government also launched several economic packages to revive the economy. These measures helped to restore confidence in the market and prevent a complete collapse of the Indian economy. Number 4. Recovery and growth. Over time, the Indian stock market gradually bounced back from the crash. The market eventually reached new highs, and investors began to regain confidence in the economy. The Indian economy also showed signs of recovery, with economic growth picking up again. The Indian government continued to implement economic reforms and policies to attract foreign investment and boost the economy. The market also benefited from India's status as a major emerging market, with investors drawn to the country's strong economic fundamentals and growth potential. Conclusion. The 2008 stock market crash had a very bad impact on economy and on investors as well, but Indian government had done very good work to stabilize the economy and gain the trust of investors. By opening door for foreign country to invest in India was also a great move by Indian government to set the economy back on track. So, that's it for today's video on Indian stock market crash of 2008. If you like the video, give it a like and subscribe to my channel. Thank you for watching.